Welcome to the Risk Reversal Podcast. I am Nathan. That is Peter Boockvar. He is the CIO at OnePoint BFG Wealth Partners. Peter, welcome to our, and I'm just going to say our, because if it's your time and it's my time, then it's our time. It's our weekly book report on the Risk Reversal Podcast.
Great to be back, Dan.
All right, you and I got a lot to do here. It is Monday afternoon. There was the all-important August jobs data that came out Friday morning. We'll talk a little bit about what you saw in that and what the market's reaction and the like, and really what's going on in the market here today. It seems like there's been an interesting rotation within the Mag 7. We're just going to call it the Fateful 8 because look at the move that Broadcom has had over the last couple of days. And then you have some very interesting, I think, non-consensus ideas here in one group that I am very interested to hear about. Okay, so we are 2 hours to the close on Monday. Aside from the fact that 10-year yield, and we're going to hit that as we talk about CPI and PPI in a few minutes, nearing 4%. To me, Peter, the most exciting thing in the market going on right now is two stocks that were added, or at least the announcement of them being added to the S&P 500. I think they go in on September 22nd. AppLovin, which is now a $183 billion stock. It's up more than 5,000% since its lows in 2023. It's up 11% on the day. And then Robinhood, which is also above $100 billion. It's a $105 billion market cap that's up 14% today. Let's talk a little bit about this phenomenon. Okay, so the S&P 500 names come out. Maybe it's M&A, maybe it's a couple other reasons about financial performance. Then other names are announced. They go in. Index buyers. Okay, these are folks that run index funds. They have to go out and they have to sell the stocks that are leaving and buy the stocks that are being added. It seems like, Peter, this often happens with stocks that are absolutely raging. I think Robinhood's up about 5% in the last year or so. Does that put some of the folks that end up owning these index funds or buying them, in the not so, does it put them at some form of disadvantage because you have a drag if these companies that are being added can't hold these sorts of levels over the next year or so?
Yeah, because upon inclusion, the indexes are essentially buying these stocks at 52-week highs. Because what we've seen, the track record of S&P when they add these names, it's only after they've had this enormous rise in their market cap. Because in order to be included, you have to meet certain market cap and profitability requirements. And typically, small companies that become big companies only become big companies after they're able to meet these requirements. So those that are owning an S&P 500 index fund end up paying much higher valuations for these companies. And the best example we both know was Tesla, when I think it was around a $400 stock when it was included into the S&P 500.
Yeah, and that one was interesting to me because, and you could throw these two stocks today, Robinhood and AppLovin. They are retail darlings. They're almost meme stocks, even despite the fact that they have these massive market caps in a way. And when you think about a Tesla, which is at the time became one of the top 20 market cap companies in the S&P 500, well, it hasn't sniffed for, I know it got back there briefly late last year, but here we are again. The stock is, $345. It just was trading at, I think, 300 not too long ago. And so when you have that sort of necessity to be adding these stocks and then they actually hit a period of digestion or, kind of pull back to some degree, it just seems like a pretty back-assward way to construct an index, Pete.
It is. And the market cap that is being added to each one of these names, I don't think when indexers are buying it, they don't care about the market cap. They just need to add it. So AppLovin, from Friday's close last week to today, adding about $20 billion in market cap. There is no $20 billion additive thing to their earnings that happened over the weekend that necessitates that. So the index buyer today is paying $20 billion more, all for an index change, and about $10 billion plus for Robinhood, not because there was any net asset value improvement over the weekend. And it's just buy high, is what the mantra is. And it is what it is, and it works until it doesn't.
I just went to ChatGPT and I just asked it, what is the average 1-year return for stocks added to the S&P 500? It said it underperforms the index by a few percent in general. But again, when you start doing this, which it has for the most part over the last 5 years, adding 100 billion plus market cap meme stocks, maybe you have that's going to end up being a lot down a lot more, underperforming a lot more than just a few percent. Pete, let's talk a little bit, since we talked last, we've had these massive moves, Google, and again, there is an example where maybe some investors, analysts, strategists view that there is the potential for a fundamental change to the business, right? We had that huge gap after that Justice Department ruling that the company was not going to be broken up. And then you also have Broadcom, which had, kind of okay numbers and guidance. I mean, they were fine. They were good, but they weren't like a huge beat and raise. But then they talked about a new $10 billion customer, and that customer is likely to be OpenAI, right? What do you make of the fact that Microsoft has really kind of gone sideways since its earnings? Well, it declined about 10%, has gone sideways since its earnings. Nvidia has pretty much underperformed. Tesla has underperformed over the last month. It seems like there's a bit of a changing in the guard, or at least just rotation within the Faithful Eight.
I think the Faithful Eight back in the DeepSeek news was really the first big test. They initially failed the test in terms of the reaction, but then this entire trade got a second wind. But it seems like that second wind is beginning to slow down in a couple things. We know Tesla, for example, their auto business, not just in the US, but globally, is getting more and more intensely competitive. When it comes to Nvidia, I think that Broadcom news highlighted that a lot of Nvidia's existing customers are trying to develop their own chips. We know Microsoft is. We know Amazon is working on their own. We know Alphabet is working on their own. And now we have OpenAI that was working on their own too, that Broadcom is actually going to complete for them. So NVIDIA's stock and NVIDIA's prospects going forward with this competition, are they going to be able to sustain a 75% profit margin? Also, it wasn't just the MIT story a couple of weeks ago with the report that 95% of companies are not seeing any return. You had Torsten Slok highlighting that the Census Bureau within the government actually came out with a report that started to question too the return on investment for a lot of companies that are using AI. There was a New York Times editorial today talking about the incremental gains from here and building out Gen AI is really slowing down. So I think that there's a multitude of studies and white papers and questions beginning to be asked about all of this and how it's all going to work out. Now, there's certainly benefits. You just typed in ChatGPT and got an answer pretty quickly. So it's not questioning, are we going to benefit from it? But in light of $300 billion that are going to be spent this year on this technology, and what $500 billion are the estimates for next year, is it all going to be worth the payoff? And at some point, are companies going to say, you know what? We've spent so much. We've developed most of our model. We're going to start to slow the pace of spend, because building these data centers, this entire infrastructure, from the top end from the Nvidia chips down to the bottom end of the cement that's being laid into the ground, is this about to slow down? And I think that's why these stocks are reflecting some tiredness.
And to your point about that, you've seen these hundreds of billions of dollars spent over the last few years. So if you can't identify the ROI, if you're one of these customers that have been actually trying out these models and trying to infuse these co-pilots or these agents into your processes and being able to monetize them either internally from a productivity standpoint or externally from your ability to sell this, this technology, I mean, that's the thing that will cause a digestion. We haven't seen it yet, but maybe if you look at two stocks, if you look at Microsoft, which is down more than 10% from its earnings, it had that huge gap higher off of a number that folks thought was pretty good, primarily in Azure. If you're looking at their cloud business, you're saying, well, you're seeing greater demand, right, for these customers of theirs that are using their compute, using their models, right? A lot of OpenAI on there. And if you start to see that slow down, then you're going to have a real problem. Microsoft stock, or maybe at least investors, are pricing that in. Another one is Palantir. It had a huge gap higher on its earnings to all-time highs, and it's since come down 17%. And I don't know if you looked at it, Peter, it's just flatlining here over the last few weeks or so. So going back to that rotation that we're talking about, the fact that you saw Google gap to new all-times, that's new money in the name after it was underperforming on a relative basis over the last couple of years to the other hyperscalers. And then you're seeing Amazon now approaching these prior all-time highs, Broadcom, as we just mentioned. So I think that like kind of rotation is important. But if you start to lose some of those prior leaders, then you have to start questioning yourself, what is the next leg of this trade? Because we're not going to, like Oracle reports tomorrow night. It's not like they're going to say anything about OCI and their cloud business that is going to change the narrative. Is that fair to say? And so who is the one that reaccelerates this trade? And I'm not sure it's Broadcom, especially if money's coming out of Nvidia.
Right, because when it comes to the stock's performance to all this news, a lot of it is the market focusing on the rate of change. We're still going to get this build out. We're going to get more people that are going to be using all this technology. But if the rate of change in this development starts to slow, that's the most important thing. Can Nvidia sustain these profit margins? Because if they can't, it's going to get a lower multiple. Microsoft, can they sustain all this spend at least on the growth rate within that? But also, Dan, isn't this also the question that's building this whole concept of artificial general intelligence? Like that's the holy grail, right, of this whole thing. And I'm reading more and more articles that it will be forever an elusive holy grail, and that it doesn't really necessarily exist, at least with what we're experiencing right now.
Yeah, and it's funny that you mentioned that because you definitely hear all these sort of brilliant minds out there. Some say there's no such thing as AGI for the very purpose that you mentioned, because the goalposts will continue to get moved, right? And then you hear, Mark Zuckerberg, who just spent hundreds of millions of dollars to hire AI talent away from OpenAI and a whole host of other folks, talking about super intelligence. Now they have a super intelligence lab. Well, super intelligence seems like better than, AGI, doesn't it? General intelligence, So to me, I think that, again, is the idea of moving the goalposts. There was another thing, and we highlighted it earlier in the market call, this headline in the information or story that came out over the weekend that, OpenAI has suggested they might lose up to $115 billion over the next, few years, I think through 2029. And you say to yourself, what sort of investors would allow that sort of just, just think about that money. It's been poof. You think about the return that you're going to have over the next 10 years from 2029 to 2039 to actually make that a sort of reasonable investment. And that's why I think all this bullshit coming out of like Zuckerberg and Musk and, Sam Altman and a whole host of other folks. I mean, how can they foresee what's going to happen based on, it's going to be a multi-trillion-dollar build out over the next few years or so cumulatively.
Right. And just to put some numbers around that, going through second quarter earnings, when you look at the CapEx numbers, particularly for Microsoft and Meta, the CapEx numbers, and if we're looking at a full year, calendar year 2025, is about 35% of revenue. Before this build out began, so call it early to mid 2022, before it really started, that number was about 13-14% of revenue. So the numbers are extraordinary. Now we all know this. We're hearing it from them, but now some of the analysis is getting deeper. I did see Torsten Slot came out with some charts today comparing the spend on AI as a percent of GDP, and I think it was around 5 to 6%. Which is very similar to the peak of the fiber optic build out in the late 90s. So when you get to these extraordinary numbers, yeah, the benefits from a technology perspective could be tremendous over the next couple of decades. But that doesn't mean that we're at high risk of an over. Well, it doesn't mean that we're not at a high risk of a major overbuild here.
Yeah. Well, one of the things that I think is screaming in silence right here, and I don't hear a lot talked about, and this was highlighted a little bit back in March when CoreWeave was going on its roadshow, right? So CoreWeave, that Nvidia is an investor. It's one of these companies that you call a neo cloud, right? So they build out this cloud infrastructure and they're basically sopping up excess capacity. And at the time of the IPO, Microsoft was 70% of CoreWeave's business, right? So CoreWeave, they buy the GPUs from Nvidia, they put them into their servers, they build out these data centers, right? And at the time of the IPO, Jensen Huang said this, all right, maybe as the CEO of CoreWeave, we could not have gotten the IPO done if Nvidia had not come in with an order on the IPO. This is a company that is not a mutual fund. It's not a pension fund. It's not a hedge fund. It's an investor, which is a company that makes the products that actually makes the Neo Cloud possible. And then there's this other company called Lambda, which is a competitor of CoreWeave that Nvidia sells their chips to. And Nvidia is turning around and renting their compute from Lambda, who buys their chips. So doesn't this remind you a little bit of some of the vendor financing that we saw back in the buildup to the dot-com implosion? And a lot of it had to do with some of these sort of similar arrangements. And I just don't know how, Peter, more people, more analysts, more investors aren't being a bit more critical of a company that's doing this sort of stuff. Forget Lambda and CoreWeave. It seems like Nvidia is empowering this sort of behavior, especially at a time when their growth is decelerating. And it doesn't mean that the company's not growing anymore, but like off of those 100% gains that we were seeing from 23 to 24, that sort of stuff.
Yeah, it just reminds us of Nortel and Lucent that were doing very similar things, financing their customer purchases of their own products. I think getting back to the stock performance relative to the fundamental situation that we're talking about is, the average person out there, they hear about the exciting story of all this AI, but they don't understand that they're in there in terms of their portfolios in terms of concentration. And I know we talked about it many times. We all know the market's been concentrated for the last year or two, and it doesn't matter until it does. But if this trade starts to slow down, if this trade gets really tired, you're talking about 35% of the S&P. And you talked about Palantir. I'll throw in some other big high multiple stocks that are beginning to look a little toppy, like Walmart or Costco, that are trading. Walmart trading with almost 40 times earnings. Costco is 50 plus times earnings. JP Morgan trading almost 3 times tangible book, let alone regular book. And that's 10. These 10 stocks, 11 stocks. You're talking about 40% of the S&P. And I am happy to see the market beginning to broaden out, particularly in small cap stocks, on expectations of Fed rate cuts. But this fundamental story has major implications for the stock market because of that concentration.
All right, because of that concentration, you're looking further afield. You just talked about broadening out. We kind of teased a little bit of something that is a bit contrarian here. So what are you looking at and why? And I know that you have some specific picks too.
So in light of the continued worries about economic growth, and just to define, first half GDP averaged only 1.4%. And now in Q3, you have the labor market that's really weakening, or at least the pace of hirings is really slowing down, as seen with the jobs report. Well, if I'm looking for those areas of the market that are the least amount of economically sensitive to all this macro stuff, and it is a group that has been destroyed, that is way out of favor, that is now dirt cheap, with a lot of these stocks paying very generous dividend yields. And that is the consumer non-durable group, particularly the food group. Names like Conagra, that has a single-digit PE ratio, that is the largest frozen food producer in the U.S. You go to the supermarket and there's a healthy choice frozen meal, Conagra is making that. If you like beef jerkies, Slim Jim. If you like popcorn, Orville Redenbacher. Very generous dividend yield. Now, I hope they continue to keep that dividend yield, but even if they cut it in half, it would still be a very generous dividend yield. What's one of the trends when it comes to eating? As budgets are getting squeezed, more people are eating at home. Well, Reynolds Consumer Products makes tinfoil and hefty garbage bags. Stock's near a 52-week low. It's yielding about 4%. It's trading at a low teens multiple. You want to talk about boring? I don't think there's a more boring stock in the entire world than a company that makes tinfoil and garbage bags. So if you're worried about the economy, if you're worried about the macro, well, I think that would fit your portfolio. And full disclosure, we own these stocks. And I'll give you two more. Nestle. Nestle just had a turnover in the C-suite as the CEO is a bit inappropriate with one of his colleagues. So there was a new CEO, but that new CEO is about 15 years younger than the one that's going out, has been with the company since 2001, has run one of their biggest divisions, Nespresso. I think that is highly attractive with a 4% dividend yield. And the last one, another boring name, International Flavors and Fragrances. That's a mouthful. Trading at its lowest multiple in many years, making the ingredients and scents that go into fragrances, foods, flavors, and four boring stocks that are not economically sensitive at all, that have all been beaten down because everyone is worried about the consumer products and food business, that I think should be owned in this kind of environment, and we own them.
All right, let's just talk about Conagra here. So this is a $9 billion market cap company. This is a company that has $8.3 billion in debt and no cash. The stock has been cut in half from its highs, I want to say, in 2022. It is just down and out. You said trades at like 9-10 times earnings. Earnings are not growing. And when you think about this, Peter, their earnings were like at, let's call it $2.50 a share. This was 4 years ago, expected to be like $2.30 or something like that this year. What's going on? I mean, aside from that one trend that you're talking about, I mean, it's got a 7%, 7.25% dividend yield. Obviously, that has a lot to do with the stock down 30% on the year. Just if it's just this eat at home sort of thing, it doesn't even feel like we're in this sort of recessionary environment. Now, that being said, go look at some of these. Look at Chipotle trading at 52-week lows. Look at Cava. I mean, some of these sort of, what do you call those, like kind of quick serve? I mean, they're a price point
It's
above.
casual.
Yeah, that sort of thing. Does the weakness in those names make you feel more excited about these less exciting names?
Well, I do like the food at Cava and Chipotle. I do think they're great business models. But when you're buying like the Conagras, the IFFs, the Reynolds, you're basically buying bonds with equity upside. And the thing with Conagra is Conagra has improved their balance sheet dramatically over the last couple of years. They got over levered with some poor acquisitions and the timing of it. They recently actually just sold Chef Boyardee, which Dan and I, I'm sure we used to eat as kids. But to make these stocks work, all you need for Conagra, for example, for it to just steady the boat, and it goes from an 8 PE to a 12 PE, and you've made 50% of on your money, and then you throw in that dividend yield. It doesn't take much to make stocks like this work. Now, they benefited tremendously during COVID when people were eating at home, but also when the inflation started to roar higher, they got hurt on the cost side, but they had pricing power to offset that. Now they still have that cost pressure, but they don't have as much pricing power. And Conagra is a perfect example of that. In their last quarter, they announced about 7% cost increases, but there's no chance they were able to raise prices to the same extent. So I'm not saying that there aren't issues with these companies, hence they're trading at 52-week lows. But I do think if the market shifts their attention to less cyclical businesses, for example, if the industrial trade, which has been so strong, starts to wane because people are worried about the economy and they start looking for defensive stocks like the food stocks, like other consumer non-durables, these companies can benefit because I still think they're very well-run companies. They make stuff that people are using every single day. And like I said earlier, I believe you're essentially buying bond-like stocks with that equity upside. And all you need is a few multiple turns of mean reversion, and you're going to get a decent total return when you throw in the dividend as well. And because the multiples are so cheap, I think you're inherently lowering your risk too by buying them.
All right. Well, I'm going to take a closer look at all of them. The Conagra looks interesting to me. All right.
You have to enjoy watching paint dry because at least that's what it's like for some of these, particularly Reynolds. It's like watching paint dry, but maybe if the markets get bumpy, those are the kind of stocks somebody wants in their portfolio.
All right, last week when you and I spoke, I think we kind of hinted the fact that, starting on Friday with the August jobs report, and then we have PPI, CPI this week, we have a Fed meeting next week. It was kind of a bit of a gauntlet as it relates to, economic data, especially when we have, most of the S&P 500 earnings for Q2 in the rear view mirror. And we're already going to be talking about Q3 earnings, I guess in the next couple weeks or so. So you think about that August jobs report, there didn't seem to be too much funny business or any funny business as it relates to kind of revisions and what we got. And now we're focused. So we go from the labor market to inflation. And then next week we have the Fed meeting. Tie all these up for me, because obviously the back and forth as far as expectations for rate cuts and then a rate cutting cycle has to do with this balance between the Fed's dual mandate of full employment and stable prices.
Exactly. So the Fed has told us, and Jay Powell made it perfectly clear in Jackson Hole, that the Fed's focus is on the labor market. And when you look at that payroll number on Friday, it was weak across the board. So we deserve some rate cuts. The question is, to what extent? Because if you look at the dot plot all year, the Fed's sort of terminal Fed funds rate, and we're going to look at it in real terms, is a 1% real rate. Well, on Thursday, the expectations for CPI is 2.9% headline, which is actually up from 2.7 in the month before, and the core rate of 3.1%. Well, if 1% is the theoretical long run real rate, well, that implies about a 4% Fed funds rate. Well, the Fed funds rate today and the effective rate is 4.33. And the market's saying, well, the Fed's going to cut 100 basis points from here all through early next year. Well, I say, okay, well, maybe the labor market deserves some rate cuts. But if inflation is still stuck at 3%, I don't know how many more rate cuts past 2 that they're going to be able to get away with. And if they go further from there, well, then you're going to risk a reacceleration of inflation, particularly if more rate cuts are going to lead to further declines in the dollar, which will add to that inflationary pressure. There is a stagflation light situation here that's setting up. And I believe that the market just believes, yeah, the Fed's going to cut. We've been trained to buy stocks when the Fed is going to cut. That's why the market is trading near 52-week highs, because the Fed is going to cut. But Friday was the first day that I noticed, well, maybe, just maybe, there are people out there that are saying, well, there's one thing to have the Fed cut because inflation is decelerating, but it's a whole different thing if the Fed is cutting in response to a weakening economy. And when you saw the S&P futures or the cash market, because this is how we opened, up 30, and then we went down 50 in a major reversal, which we're still below Friday's morning highs, the market is beginning to realize, and maybe taking out their history books, that when the Fed cuts interest rates in response to a weaker economy, that is actually a threat to stocks, not a booster to stocks, as we saw in the early 2000s and we saw obviously in the great financial crisis.
So what do you think is the bigger risk right now? You just mentioned stagflation. I mean, is the risk that you're going to see unemployment move to the downside quicker than inflation move to the upside, or is it just impossible to tell right now?
I think the biggest risk is a further slowing in the economy that the Fed is not going to be able to deal with aggressive rate cuts, because the inflation stickiness is going to tie their hands. So yes, they're going to give us a couple of rate cuts this year, maybe even 3. But their inability to get aggressive with rate cuts, I think, is the biggest risk here.
Lastly, let's just kind of tie this all together here. You have a 10-year yield at 4.05%. Is the rate market running ahead a little bit of what you think, the Fed is likely to indicate the pace of cuts? And I know you just spoke to this a little bit, but the whole idea that when we finally get to the Fed decision, right, on that date on September 17th, might we see, equities that have been rallying a little bit despite what we're seeing is poor economic news, right? Because they're excited about a rate cut. I mean, like in this environment, that doesn't seem to make a whole heck of a lot of sense. But when we kind of get that cut, then we kind of wait for it. Do we get dots this meeting or?
Yes, we do get dots, and then it'll get updated in December. And now the dots will come the day before the CPI number, because the bond market has now priced in a more aggressive Fed. Not a Fed that's cutting rates back to zero, those days are over, but a more aggressive Fed. And if that CPI number comes in hotter than expected, you will see a major adjustment in the bond market, mostly on the longer end, because I think the bond market understands that post Powell, and we'll obviously see what will happen with Lisa Cook and so on, that to me, there's still risk to the upside in long-term interest rates. And the CPI is going to determine how much the Fed's going to be able to get away with short-term interest rates. It's amazing to me. A lot of people think that, okay, long rates are just falling, gig is up. We're not going to see a repeat of the Fed last year when they cut short rates and long rates went up. I want to still caution people that I still think we're in a duration bond bear market that is global, and that yes, we've had a nice rally here in long rates that has complemented the fall in short rates, but I don't believe in the sustainability of it. I don't think people should get too cute thinking that Fed rate cuts are going to be the end all be all and solve all our problems.
All right. Well, I got plenty of problems that need to be solved, and I don't think it's anything that's going to come with a rate cut by the FOMC. Peter Boockvar, I appreciate you being back here. You made me smarter. So let's do it again next week. How's that?
I can't wait. Thank you, Dan.
Thank you so much.